You're probably aware that last month the US Federal Reserve, the US Central Bank, it's a great fanfare, announced that it was reducing its asset purchasing program by $10 billion. So we're going to reduce it from $85 billion a month down to 75. So I thought now is an opportune moment to look at this whole quantitative easing experiment and to try and see what impact it has had, if any. And obviously, if we can determine where the impacts have come from, we can then sort of determine for how much longer it may continue, whether it will continue into infinity and beyond. Because it has been certainly a very interesting 6-year period, both for investors and investment managers alike. Since the credit crisis in 2008, central banks have been very aggressive in finding all sorts of different ways in which they can prop up the financial system. And we come into work these days, do our sort of daily, eight and a half hour shifts, whatever, and these sort of $85 billion monthly injections, we almost just take it in our stride now, we just take it for granted. If this was happening in Russia, we would just say this is state intervention of the worst kind, and yet here we are in the Western capitalist societies that we live in, quite happy for our central banks to intervene. So what we'll do this evening, I'm going to sort of look at the basic mechanics of QE, because depending on who you speak to, we need to really sort of be clear exactly what QE is and what QE isn't. It's not really printing money in the true sense of the word. It's not Ben Bernanke flying over Lower Manhattan in his helicopter, dropping $50 bills into his friends at Goldman Sachs and elsewhere. But the whole sort of purpose of the presentation as well was to touch on some of what we consider to be the key themes for 2014. And as we go through, I'll just sort of point these out to you as things to sort of look out for as we go through 2014. Now I'll start off just to set the scene, because this is something that you need to keep in mind as we go through the presentation and go through the remainder of the year. We must acknowledge, and we must give some credit to Western governments, and acknowledge that in the main, annual budget deficits, the amount that the government spends in relation to the amount that it receives each year by way of tax, etc., in the US and the UK have trended lower over the last 5 years. And this is what you hear George Osborne and David Cameron talking about all the time. The deficit is coming down. They're imparting a lot of austerity on the British public, but the bottom line is, year in, year out, or year on year, should I say, over the last sort of 3 years, there has been an element of deficit reduction. But at the same time, the overall debt levels have continued to rise. And this was a legacy almost of the 2007 credit crisis. It was debt that brought us to the credit crisis, and I suspect that it will be debt that will sow the seeds for the next crisis as and when that occurs in future. We've got high levels of debt, and at the same time we've got historically, generationally low levels of interest. And that's helped governments in the short term, but it doesn't address the fundamental issue of what is going to happen to this debt and the cost of servicing it if interest rates creep back up to the sort of levels we saw 5-6 years ago, 4.5%. Of course, governments would love to inflate away their debt. If you're a borrower and inflation is high, then the real cost of servicing that debt just falls away. But of course, they're served by central bankers who have mandates these days to guard against inflation, to adopt monetary policy that keeps inflation levels low. So this high levels of debt, both at government and household level, will remain one of the key themes for 2014. And just to put it into some sort of context, the US economy, the largest economy in the world, total government debt, $17.07 trillion. It's doubled basically in the time that President Obama has been in office. Their debt to GDP ratio is about 101% at the moment, and they spend about $415 billion a year just servicing that debt. The money doesn't build hospitals, it doesn't build roads, it just rolls over the existing debt that they have. The European Union, obviously a very disparate bunch of nations at the moment. They have public sector debt of 8.75 trillion. The debt to GDP ratios, it's quite variable from one country to the next. Even Germany, which has sort of been the driver of economic growth in Europe in the last 5 years, they have a debt to GDP ratio of 81%. When you get down to some of the more stressed countries, Greece is 160, Italy is 130%, Portugal is 127%. None of these debt levels have gone down at any point really in the last 5 years. The UK, even in the UK, we have excessive levels of public sector debt, £1.2 trillion, which the Bank of England is currently holding about 375 billion, about 31%. And Japan, of course, Japan mired in inflation for the last 20 years. They have, in dollar terms, it's $10 trillion. Their debt to GDP ratio about 220%. We'll talk a bit more about Japan later on because there's a lot of things going on there at the moment. Now, just to sort of be clear as to where we are with quantitative easing, if you think about it, within the banking system, the central banks have traditionally sort of maintained this role, this relationship with the commercial banks, where they assume this role of lender of last resort. Liquidity passes between depositors and banks, it passes between banks and banks, and it passes between banks and central banks. And in periods where there's a sort of liquidity squeeze, and banks don't want to lend to each other, the central bank will step in and they will provide liquidity to the system if banks need to use that money to pay depositors. Now, historically, when I first started in the industry 20 years ago, when I worked in the bond markets then, central banks were sort of clouded in secrecy. They didn't have monthly policy meetings, and if they did, they never told anybody about it. They just controlled their activities at the ultra short end of the bond market, in the treasury bill market, essentially. Weekly treasury bills, 90-day treasury bills, etc. If there was a liquidity shortage in the banking sector, the central bank would they would satisfy that liquidity requirement, and they would set the interest rate that the banks could borrow from them at that sort of rate. And that was very much the market interest rate at the time. And there was no major announcement. It would appear on your Reuters screen and somebody would mention there'd been a rate cut or a rate rise, and on we would go. Today, of course, central banks have monthly meetings. They have this sort of forward guidance, and everything's done right under the gaze of a watching public. Very much these days, investment decisions are often sort of driven by what's the central bank going to say at its next monthly meeting. But historically, their activities were always concentrated very much at the short end of the system. Now, the trend, as I say, in the last 10 years has been for committees to hold these meetings. And when the credit crisis reared up in 2008, again, we must, I suppose, looking back, be grateful that the central banks were quick to cut interest rates and provide the short-term liquidity to the banking sector at a time when banks didn't trust each other and didn't want to lend to each other. That liquidity restored confidence to the system and stability. It enabled banks to borrow money from the Federal Reserve or from the Bank of England or from the ECB, and eventually stability returned and the banks started lending to each other again. Now, since then, the central banks were also very quick to cut interest rates to historically low levels, and now most of them are pursuing this zero-rate interest rate policy, which is a method of, if you like, keeping. It's trying to stimulate economic growth by keeping interest rates anchored as closely to zero as possible. And under this policy, for instance, the Federal Reserve in the US, they're maintaining a 0% nominal interest rate. And by reducing short-term rates down to zero, it helped the banks, again, the people who borrow at the very short end of the yield curve, but it did very little to help those consumers and homeowners with mortgages. And of course, if you look in the context of the United States, consumer spending at the time was making up about 66% of economic growth. So central banks turned their attention to looking at ways to either influence or reduce longer-term interest rates, and quantitative easing, QE, was seen as one of the solutions. And all QE is, it's just really an extension of it's the bank's open market operations that they use at the short end of the market, but just extending them out into the future. They use it to try and stimulate the economy when standard monetary policy becomes ineffective. You can only bring interest rates down to zero. You can't go any lower. So this is the next step to try and sort of kickstart growth and return the economy to a state of health. So that a central bank would typically implement QE by buying specified amounts of long-term financial assets from commercial banks and other private institutions. This has the effect of increasing the monetary base. It doesn't really do much to the actual money supply, as we'll see shortly, and it lowers the yield on those financial assets, and that in turn has an influence on the deposit rates or the mortgage rates that banks will charge new borrowers. And the whole idea was it was to try and sort of kick-start the housing market and stimulate a bit of growth. And they tied this in. The third sort of strand, the third unconventional measure, is forward guidance. And all this is just another attempt by the central bank chairmen to influence longer-term rates by talking rather than their deeds. Mario Draghi was hugely successful. The most success the ECB have had in actual fact at sort of calming the volatile bond markets when he said in July 2012 that we will do whatever it takes to preserve the euro, and believe me, it will be enough. They threatened to put in place, they have put in place this outright monetary transaction facility, which no one has actually used yet, but just the act of saying this has so far becalmed the European markets. So what they tend to do now is they try to exert influence further at interest rates further down the line, borrowing for longer periods of time, through their words as well as their actions. And in terms of the way these unconventional measures have been deployed since the credit crisis, the current total's it's more than that now. This was the position at the end of the second quarter 2013. McKinsey's recently published a discussion paper to look at the distributional effects of QE, and this graph was sourced from that report. And we've seen these unconventional measures applied in all the major sort of investment locations around the world. The Bank of England did £375 billion of QE through its asset purchase programme. Japan is currently in the throes of Abenomics. The ECB has bought some bonds from the peripheral nations such as Spain and Italy, but their main weapon has been their long-term refinancing operation, where the ECB provided loans to the banking system but extended them from the normal 3-month period out to 3 years. They injected over €1 trillion into the money markets over two long-term loans. There was one in late 2011 and another in early 2012. But since the start of 2013, banks have repaid over a third of that cash. And since the credit crisis, the US Federal Reserve has embarked on several rounds of QE. So before we look at the QE experiment in the US, we need to be clear really exactly what QE is and what QE isn't. And there's a very simple example here which will hopefully shed some light on this mysterious sort of concept. As we know, that the Federal Reserve has expanded its balance sheet quite considerably in the last 6 years. It's gone from about $800 billion up to just around $4 trillion today. And they've done that by buying assets from the banking sector, mortgage-backed securities from the likes of JP Morgan and the other commercial banks. And more recently, they've focused a lot of their investment into buying treasury bonds or treasury notes that are held by banks. And again, the whole idea of this is to provide a bit of liquidity, but really to try and influence, chiefly, the whole motive for me is to influence long-term interest rates and keep interest rates low. Because as I said at the very beginning, debt levels are so high, if interest rates go up, it's going to devastate government's ability to be able to service that interest in the absence of being able to inflate it away. So if you look at this example, this is just a very straightforward example of the Fed buying a treasury bond from the bank. On the left-hand side there you've got the bank's balance sheets before and after the transaction. They have assets worth 110 and liabilities also thankfully worth 110. We will assume that they are valuing their loans at fair value and they're not doing any sort of some of the shenanigans that have allegedly been going on in the last few years. But they have on their books, on their assets side, they hold a treasury worth, say, $40 million. Over at the Fed, at this moment in time, before the transaction, they have a flat balance sheet, no assets and no liabilities. After the transaction, you'll see that the Treasury has disappeared from Bank A's balance sheet, and it has been replaced by $40 million worth of reserves. And what the Fed does, they do effectively create money out of thin air. They will buy, or they will reflect the Treasury bond on their balance sheet, and they will credit Bank A's reserve account at the Federal Reserve. Now, if you look at this in plain terms, you can see here that the main effect of this transaction is that reserves have increased due to the Fed's bond purchase. There were reserves of 50 before this transaction, and now reserves have gone up to 90. Now, if we assume, as is the case in the States, that there's a minimum reserve requirement of 10% of deposits, you could have said before that transaction Bank A was holding reserves of 50, of which 10 would have been required reserves and 40 would have been these so-called excess reserves. Post this transaction, the excess reserves has now doubled. You've got 40 plus 40 plus 10. So the main effect of this has basically been the Fed has swapped reserves for a bond that already existed in the marketplace. The number of assets in the system is the same. The composition of the bank's balance sheet is also the same. And recall as well, or bear in mind as well, that this transaction has no bearing on the bank's ability to lend money. That's a function of simple demand from clients to want to take out a loan. The bank gives it the loan. The client goes and spends it. It ends up in another bank account, in a deposit. That creates new money that gets loaned out, and that's when you get the inflationary effect. This has done nothing to impact on inflation at all. And you could argue that that is QE, because the Japanese have tried QE on several occasions and they're still mild in deflation. They did the same thing. Didn't have a hyperinflation like a lot of people fear we're going to have. The main result of this is that the Fed has increased the monetary base. The monetary base has expanded by 40, the value of the Treasury, but the money supply has not been severely impacted. And it's the money supply and the velocity of money that really generates inflation and credit. Now, the Federal Reserve, in 1977, the Federal Reserve, the Congress amended the Federal Reserve Act. The Fed says it has this dual mandate, and the Act says that the Board of Governors of the Federal Reserve System, the Federal Open Market Committee, should maintain long-run growth of the monetary and credit aggregates, commensurate with the economy's long-run potential, to increase production so as to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. And we can see here that since the onset of the credit crisis in 2008, and also since the recovery in US economic growth since 2010, the Fed has expanded its balance sheet from $800 billion in 2007 to around $4 trillion today. Now, I won't go into the detail here other than to say that they've tried different QEs at different time, and the one that they're running with at the moment, which I called QE to infinity, was an extension really of QE3, which was announced in September 12, where they said they were going to buy $40 billion a month of mortgage-backed securities, and in December that year they said they were going to add another $45 billion of US Treasuries and just carry on doing it indefinitely. QE1 that was undertaken or announced at the end of 2008 was very much about providing support to the US housing market. The banking system had already been stabilised by some of the Federal Reserve's other activities, such as the troubled asset loan facility, and they also granted other loans to the banks as well. But QE1 was very much about the housing market. You know, the press release that accompanied it said that this action is being taken to reduce the cost and increase the availability of credit for the purchase of houses, which in turn should support housing markets and foster improved conditions in financial markets more generally. QE2 and QE3, there was a common theme coming through by then, and it's the Fed's standard line to promote a stronger pace of economic recovery and to help that inflation over time is at levels consistent with its mandate, which could mean anything, quite frankly. Operation Twist that was undertaken in September 2011, again, the rationale for that was to support a stronger economic recovery and help ensure that inflation over time is at levels consistent with the dual mandate. That involved selling a lot of the short-dated bonds at the Treasury that the Fed already held and switching them, twisting them into longer-dated bonds, the idea being that the more longer-dated bonds you buy, the prices go up, the yields come down, and that provides assistance to long-term borrowers, chiefly US consumer house owners. Now, we really need to just sort of have a look to see how these various QEs have impacted on, whether they've satisfied the Fed's dual mandate, I suppose. I mean, why undertake them if that wasn't the reason for doing it? I'll quickly sort of blast through these. We can make the slides available afterwards if anyone wants to see them. But the example that I just did with the bank selling the Treasury to the Fed sort of indicates that despite fears in some quarters that all this so-called money printing would lead to hyperinflation, 5 years on from the start of the first QE, this has really yet to manifest itself in the US economy. CPI in the US is currently running at just 1.2% annualized. The evidence suggests so far at least that QE has not caused inflation. And as I'll show you in a sec, the reason for this is that most of the QE money, most of this money that the Federal Reserve has created, is tied up in bank excess reserve accounts at the Federal Reserve, earning a small amount of interest. Now, for that reason, I would suggest, because this money isn't in the system, there is no reason to believe that QE is inflationary. It's not adding any net new financial assets to the private sector. That said, while inflation remains subdued, we must acknowledge that there has been a moderate increase in consumer credit in the States over the last sort of 3 to 4 years. Rather, as the economy has recovered, household levels of debt in the States were very high anyway, but we have seen an uptick in credit cards, loans for car purchases, and also personal loans. The total outstanding amount at the end of November was $3 trillion. That's an increase net from $2.6 trillion in 2008. I just cut and pasted that comment in red from a previous presentation I did here. I mean, you could argue, everyone's sort of been worrying about the inflationary effects of quantitative easing, but you could argue that the steps that the Fed took in the early part of the recovery were more aimed at firefighting deflation rather than trying to stimulate growth and inflation. The chart, the graph on the top right, shows the amount, if you like, it's the value, the expansion of the Fed's balance sheet over the last 5 years. Now it's over $3 trillion now. The graph below it shows bank reserves at the Federal Reserve. One has gone in tandem with other, and I hope that the example I sort of put up earlier can show that. Now, you could argue, of course, that if all these reserves found their way into the system, as it were, we would have hyperinflation. But that's highly unlikely to happen because banks don't use their reserves for loans. They use reserves to meet short-term financing calls from depositors if there was a run on the bank, like a Northern Rock scenario. But excess reserves do not constrain bank lending in any way, shape or form. Bank lending is a function of consumer demand for credit. And since October 2008, the Fed has been paying interest of 0.25 on these bank excess reserves. It doesn't seem a lot, but as the reserves add up, it's quite a substantial amount of money. So at these levels, you see, the banks have no incentive to lend at interest rates lower than the rate paid by the federal bank. It suits them just to leave these money tied up at reserves with the Fed, where they can earn this 0.25 interest. And it works quite well for the Fed as well, because they can therefore adjust the interest rate it pays on reserves to try and steer market rates towards the level that it wants to steer them to. In terms of the impact of the effect, if you like, of QE on unemployment, because part of the dual mandate is to ensure or trying to strive to achieve maximum employment in the States. Yeah, again, we can say that in the last sort of 2 to 3 years, there has been a downward trend in the official US unemployment rate. But, it's very difficult to measure the impact of QE on unemployment because there's so different measures of unemployment. For instance, part of the reason that the employment rate fell to 6.7% last month was that the number of Americans not in the labour force rose by 535,000 people to a new all-time high of 91.8 million. The chart below is what's known as the activity rate or the participation employment rate, and that's one that's used quite often by the OECD. And all that is, it's the active population, which is defined as employment plus unemployed, divided by the working age population. In other words, what proportion of the working age population is either working or officially listed as unemployed. And any decline in that chart suggests that it would indicate that the working age population is leaving the workforce. So the official rate's coming down, but there's other factors at play here rather than just creation of new jobs. And QE, we can certainly say, hasn't helped the 47 or so billion Americans, 1/6 of the population, who are still on food stamps. In times of a more normal monetary policy, it's often said that the effects of an interest rate cut can take between 6 and 12 months to filter its way through the economy. And it should also be recognised that unemployment is in itself a lagging indicator. So we can't make anything other than a tenuous claim that QE had a direct effect on unemployment. As far as long-term interest rates are concerned, the top chart shows the 30-year US mortgage rate in the States, and you can see that it's trended down since 2008, down to about 2012. And in that regard, you could argue that mortgage rates have benefited from the activities that the Fed has been carrying out in terms of its bond purchases of mortgage-backed securities. The chart at the bottom is the 30-year Treasury bond yield, and the boxes that I've put around that are just showing different QEs at different times in the last 5 years. So the first one's QE1, the second one's QE2, the third one is Operation Twist, and you would have expected yields to have fallen during Operation Twist because the whole idea was to lower the yield at the long end of the market. So that worked. But if you look at what's happened recently, in the last 6 months or so, notice how bond yields, both mortgage yields and treasury yields, have crept back up during 2013, and this is despite $85 billion a month of Fed purchases of these assets. The evidence suggests that while Operation Twist succeeded in lowering long-term rates between 2008 and late 2012, as one would have expected, the Fed has had little influence over long-dated Treasury yields overall. And as far as growth's concerned, it's interesting to note on this chart, the one at the top there is just US GDP over the last 4 years. The one at the bottom shows it in a broader context going back to about 2000, 2001. And you can see that growth in the US was trending lower even before the credit crisis flared up in 2007. The recession that occurred in 2008 was an incredibly deep and severe recession. It nearly brought the global banking system to its knees. It crashed US house prices in a way that a whole generation of people had never really seen. But it was quite quick in the way growth was restored. By 2010, the economy was still in a very weak state, in a very stressed state, but it was at least starting to grow again. You were getting quarter-on-quarter periods of growth. So we should acknowledge, even if grudgingly so, that the action undertaken by the Federal Reserve and the US Treasury in 2008-9 to restore liquidity to the banking system, again via programs such as the Troubled Asset Loan Facility, did at least bring some stability, a much needed stability, back to the system. It provided the banks with the confidence to lend to the Fed and ultimately to lend to each other again. Just looking at the overall winners and losers of this sort of experiment, the obvious winner has been the government, whether it's the US government or the UK government. It has in part been benefited to a significant degree from lower borrowing costs. Yields have come down at certain times in the last 5 years. Short-term yields have remained very low by historic standards, and it's enabled it's enabled governments, as one of their bonds has matured and they've had to pay it back to an existing creditor, they can go to the market and issue new debt at a much lower rate than the rate that they were paying on their previous debt. They've also benefited from this recent activity, I suppose. It's been going on in the States for a good few years. The Bank of England started it in the UK in 2012, of repatriating interest payments from the bank back to the government. Now think about this. If you buy a gilt's just an IOU that the government issues. They pay a rate of interest, usually every 6 months. And at the end of the period, you get your money back plus the last interest payment. The interest payments are called coupons. Now, a lot of the debt that the Federal Reserve has bought and the Bank of England has bought, every time a coupon has been due to be paid, the government pays the creditor the interest, and the Bank of England and the Federal Reserve pays it straight back to the government. It's like a zero coupon bond. It's free borrowing. And this has been going on, for the last sort of 5 years. The Fed estimates that it's given back $350 billion in interest payments remitted back to the Treasury since 2009. And this has been a good thing in some respects. People might talk about moral hazard, etc., but it's been a good thing because in some respects it's made government deficits look better than they otherwise would have been, and it's allowed governments to spend money on other things as well, rather than just paying interest and not seeing it again. The banks have benefited enormously because the central banks have provided a huge amount of liquidity and solvency. We still don't really know how strong a lot of the listed banks are, because their balance sheets are still very opaque, because accounting rules still allow them to hold assets at what we wouldn't necessarily call fair value if they had to sell them tomorrow. But the fact is, the actions of the central banks that they've taken in the last 5 years has restored a huge amount of confidence. And again, as we've seen in America, any bank that's got excess reserves with the Federal Reserve is earning a nice rate of interest at the moment. Why lend it on? Why take the risk when you can just have a riskless 0.25 from your friendly central bank? Borrowers have also benefited because in this low interest rate environment, if you've been fortunate enough to be offered credit, you've been able to borrow at much lower rates than were available 5 or 10 years ago. The biggest losers, you would have to say, have been savers. And this is a common theme that we've seen in our office in the last 12, 18 months. Hitherto very conservative people who've never really embraced the stock market and never really had any appetite to do so, have seen their deposits absolutely decimated by the drop in interest rates since 2008. They're getting negative real returns on their deposits, and they're now looking at stock market investment as a means of replacing lost income. You could also say as well that people talk about Main Street, and in some respects that's right, because when interest rates were cut in the States in 2008, 2009, commodity prices initially rose quite sharply. Now everyone suffers from higher fuel bills. The elite who can afford to invest their money in the stock market and who have investment portfolios can benefit from rising stock markets. But at grassroots level, everyone's got to fill their car, everyone's got to pay their energy bills, etc. And this impacted on a much wider proportion of the economy. This is maybe one of the unintended consequences of quantitative easing. And just to summarise, looking at the US experiment, that box on the right side is just a trend in the US federal funds reserve, the rate that the Fed lends to the banks. Short-term interest rates, they're down at 0.25% at the moment, and they have stayed at historically low levels. Bond yields, as we've seen, have fluctuated across the maturity curve, apart from at the very short end. But with timing of different and that's happened with timing of different phases of QE, but they haven't been controlled by the Fed. The Fed could only control the bond market if it owned every bond that existed. They don't. It's a $17 trillion US Treasury bond market. They own 2. There are other players who can have influence on bond yields. The Fed owns over $2 trillion of government debt, as I say, but there's little to suggest that their actions in the Treasury market have had a major impact on yields. The dollar weakened as the Fed moved to cut the Fed funds rate, so there was an influence here. There has been an influence between the actions of the central bank and the dollar. Inflation levels have remained low because demand for credit has been relatively subdued, and banks have not returned to the lending habits that preceded the crisis. And I would give the Fed and other central banks credit for restoring confidence. QE1 provided liquidity to the banking system, and they were right. At the time they said we have to do this because where would we be if we didn't? And when you look back now, they were probably right. We would be in the depression that we should have had 5 years ago, but has not happened because of the actions that the central banks have taken. And the one, I suppose, byproduct of all this is that the environment, this environment of confidence that I think has sort of has returned since central banks have decided to go down this aggressive route, has seen a renewed appetite for risk. We often say that markets don't repeat, but they rhyme, and we'll see in a sec that investors seem to have gone back to being quite happy to embrace some of the risks that we saw 5 or 6 years ago. Now, when McKinsey did their study of the distribution effects on QE, they found that it was difficult to measure the degree to which QE had pushed equity markets higher. And I would make the point here that since 2009, this is the S&P 500 index, 500 leading US quoted companies by market cap. It's gone up by over 160% in the last 5 years. Coincidentally, during this period when the Federal Reserve has been so active in providing assistance to the banking system. But McKinsey's findings, in their findings, they said that there's little evidence of a large-scale shift into equities as part of a search for yield. Price-earnings ratios and price-to-book ratios in the stock market are no higher than long-term averages. But coincidentally, you can see that during periods when QE was in operation, we had these fantastic rallies in the stock market, and when they were breaks in between, the stock market sort of recorded anything between mid-single-digit and nasty double-digit returns. This chart only went out to April 2013, so I just added the blue arrow because the S&P is up over 1,800 points at the moment. As far as US housing is concerned, it's very hard to get a complete picture of the US housing market in the States because it's such a vast and disparate market, driven by domestic consumers and overseas buyers. But since 2011, there has been an upward move in building permits and existing home sales. Now that's the two charts on the left-hand side there. The upward trend in building permits is encouraging because that lends support to the construction industry. These are permits for future US home construction. The S&P Case-Shiller 20 City Home Price Index, which is the one on the top right, is showing a modest recovery in house prices, although these prices do remain somewhat below pre-crisis levels. But on the other hand, and this is a key theme that we need to be keeping an eye on for 2014, is that the recent results of the leading mortgage lenders in the States have shown a significant dip in the number, there's been a dip in the number of existing home sales. And this week, the three largest mortgage lenders all reported significant drops in new mortgage lending. Now, Wells Fargo, that's the one in that bottom right graph there that has the black column. They're the largest mortgage lender in the States. They have about 25% of the market share of the US mortgage lending market. And they said they funded $50 billion in residential mortgages in the fourth quarter, which was down 60% from $125 billion in the year earlier period. JP Morgan reported it funded $23 billion in mortgage loans in the fourth quarter, which was down 54% from a year earlier. And Bank of America, the third largest originator by market share, said it originated $11.6 billion in mortgages in the fourth quarter, down 46% from $21.5 billion in the year earlier period. Now this is significant because we may be seeing some lagging signs here. I wouldn't say that building permits is, because that's a positive leading indicator. As I say, it's a sort of a forebear of construction spending. But it is a concern that at a time when, as we saw earlier, yields on mortgage rates have crept higher, there's suddenly been this large drop-off in mortgage lending. We need to see more data, though, to see whether this was just a sort of seasonal one-off or whether it's the start of a more sort of worrying trend. Now, just on last bit on the US here, there's been an awful lot of hysteria about this issue of tapering. This has sort of been in the public spotlight, really going back as far as May last year, when Ben Bernanke at one of his press conferences sort of suggested that if the economy still showed signs of improving, the Fed would start to take steps to ease back on this £85 billion a month of asset purchasing that it's been embarking on for the last year or so. And this sort of sent equity markets into a tailspin at the time, because everyone was worried that, as the US economy recovers, tax revenues will go up, budget deficits should come down, the government will have less need to borrow, and therefore the role of the central bank in sort of providing support to the economy would diminish, and the Fed could sort of pull back and not provide all this assistance. As it turned out, he didn't do anything in September, and then lo and behold, at the last committee meeting before Christmas, they announced that they were going to cut their spending back, their asset purchases back by $10 billion a month, from $85 billion to $75 billion. Now, as things stand, this really isn't a problem because this is still a massively accommodative policy. They're not saying we're going to turn this off tomorrow and we're going to sell all the bonds that we've bought back in an orderly manner back to the banking sector, and we're going to go away. I mean, they may have to at some stage, but that's for another time. Now, they have said that further tapering, as they describe it, is very much data dependent. Bernanke said that they could potentially do 10 billion a month if the signs were there that the economy was showing significant signs of improvement. But quite frankly, if the economy starts to take a turn for the worst, I think they'll come back and do some more. It's there. It's like a tap. They could sort of switch it back on again if they want to. I don't think they do particularly because they are probably concerned at the burgeoning size of their balance sheet and how they are going to unwind their balance sheet going forward. But as I say, I mean, if the economy was improving, they'd be able to sell these bonds perhaps in a relative position of strength. And there's various options available for them. I mean, they exchange these bonds with commercial banks for reserves. Well, they could just sell these bonds back to the banks, not necessarily the ones that they bought them for, but they could do it through, repo arrangements or reverse repos, and just absorb those excess reserves and give the bank their bond back that sits back on their asset sheet. They could reduce interest payments on reserves as a means of encouraging banks to start lending again. They could impose a tax on banks that hold high levels of reserves, but that would be slightly contradictory. As we've already established, it was the Fed that created these excess reserves in the first place. But there's a very sort of strong symbiotic, it's more than a symbiotic relationship between the central bank and the banks that it deals with. There have been concerns that if the Fed held onto its bonds for too long and interest rates went up, they could incur massive losses. And no one really knows how that's going to play out yet, but you could take a very crude view and just say, well, the Fed can't incur losses because the Fed can create money. So they could just create a deferred asset on their balance sheet to absorb any losses that might arise in future. Everyone is totally fixated on what the Federal Reserve is going to do next. We look at the way markets react before and after Federal Reserve monthly meetings and press statements. And as I say, in the old days, central banks used to be very quiet. They were very much under the radar. And it would probably be in the Fed's interest just to go away. They could sort of say to people that we're going away now. We'll still be here if you need us, but we're going to be much more passive. But of course, if they did that, everyone would think, what the hell's going on here? The Fed's not going to be helping anymore, and that could create some instability. It's just got to that stage now where there's far too much reliance being placed on what the central banks say and what they do, and it's putting them under probably quite a lot of pressure. I would say, the other thing that the government could do, the Congress, or in the case of the UK government, they could just pass law requiring banks and other financial institutions to hold more government and corporate bonds. They could say, right, well, here are your Tier 1 reserves, here's your Tier 2, and now we want you to hold X% of your balance sheet in government bonds as a buffer in case there's another liquidity crisis. And that's, again, probably an element of financial repression. It's forcing people to sort of do things that they may not want to do, but again, it's another way of stimulating demand for debt if the Federal Reserve and other central banks eventually remove themselves from this process. But I wouldn't really expect any of these things to happen in the immediate future. Everyone's sort of getting into a bit of a flap about this tapering, but I suspect it's going to be a very, very gradual process. They can't do it all in one go because people are worried that if they unleashed all these bonds back into the banking system, that there'd be a huge supply problem and yields would go back up. But in reality, that may not happen. Banks could just reacquire those bonds, the reserves go back to the Fed, and they just get absorbed away. Now we'll move away from the States, and I'll quickly blast through these. The whole sort of, if we look at Japan, they're embarking on an even more aggressive program of growth stimulus than America. And the origins of all this were in the Tohoku earthquake in 2011 that severely damaged the Fukushima power plant. And we know that for years Japan has been highly dependent on nuclear energy as its primary source of energy. Since Fukushima, they've reined back on that, and now they import a huge amount of fuel at a significant amount of cost. Fuel imports account for about 36% of total Japanese imports. And for a country that for years and years, although it was sort of mired in deflation, it always seemed to manage to run a reasonably healthy trade balance. You can see that in the last year or so, because of the cost of importing fuel, they're now running a trade deficit. Now, there was a change of government last year. Shinzo Abe, he's basically undertaken with the new governor of the Bank of Japan a very aggressive program of monetary stimulus. Now, it's got a sort of three-pronged or a three-arrow approach: aggressive monetary easing, a credible fiscal plan, and growth strategy based on structural reform. And what they're doing, they're targeting, from having been in deflation in and out for the last 24 years, they want to target a 2% inflation rate. They're looking to decimate the yen by about 15 to 20% year on year so they can boost Japanese exports. And you have to bear in mind that they've said that they're going to do $70 billion a month of QE. Now, bear in mind that the Fed was doing $85 billion at its peak, and the US is an economy 3 times the size of Japan. So this is an incredibly aggressive strategy that the government are taking on. That top chart is the dollar-yen exchange rate, and it's now back up at 104. And last year we saw an 80% rise in the Japanese stock market because everyone thought this is great, this is very aggressive. We haven't seen one of these for a while. Let's hope it works. Let's invest back into Japan. And Japan nearly doubled in 2013. I fear that as much as it would be great if it does happen, I think they'll be successful in perhaps getting inflation up temporarily, but you sense that the plan is fraught with danger and is probably doomed to fail. They already carry massive levels of debt, Japan. The Japan government's already been one of the main buyers over the years. The chart on the right shows this yawning annual budget deficit. They haven't run a surplus for donkey's years. They're talking about bringing a sales tax in this year, like VAT, which is going to go up from 5 to 8%. And the effect of that is to boost revenue to offset some of the spending that the Japanese government's doing. But that's going to be a tax on consumers, so I don't see how that's going to stimulate the consumers very much. And also, demographics in Japan have never been particularly supportive of GDP growth. There's quite an aging population in Japan, and a total dependency ratio of about 61%, and that's a dependency of people who are sort of old and retired against the people in the working population. They have a very poor track record in structural reform, Japan. They've been trying to reflate their economy for over 24 years, and every time they get close, something happens and it fails, and they go back into deflation. And I suppose the other question is, you've got to weigh exports against imports. They can destroy the Japanese yen, but it's going to increase the cost of their fuel imports significantly, and they don't have any other sources of energy in Japan. They have to import a huge amount of fuel now. I suppose the other thing is, if they're looking to devalue their currency by 15% a year, you have to ask, are their trading rivals in the Southeast Asian region just going to sit back and idly let them do this and take market share from them? I very much doubt it. I suspect there'll be some currency wars this year, so that's another theme. And also, if you're a rational investor and you were looking to buy a government bond, you certainly would be less inclined to buy it if you had a government and a bank that was hell-bent on cranking inflation up, because it just destroys the real income that you get from your bond holding, which is why I suppose the government is going to be, or the Bank of Japan is going to be one of the main buyers. As far as the Eurozone is concerned, it's a completely different situation in the Eurozone. Their sort of stimulus in the last 5 years has been aimed very much at helping the banks rather than, or sort of providing loans to the banking system rather than sort of aggressive buying of assets held by the banks. And the danger here is, the main theme for 2014 is whether the ECB will be able to act in time to prevent the Eurozone economies falling into outright deflation. The ECB doesn't have a very impressive track record at sort of getting their market timing right. We know that none of the world's central bankers foresaw the 2008 credit crisis, but the ECB was the last authority to lower their interest rates about 18 months after it had started. They held their refinancing rate at 4% well into 2008 and actually raised it to 4.25% later on that year, 12 months after the credit crisis had started. Now, there is a suggestion, or there has been, there are sort of rumours now that they may embark on some sort of quantitative easing program themselves. Where they have lent money in the past, it's always been quite neutral, because if they've sort of bought a bond, they've cancelled that part of them, they've reduced the money supply, so the effect of one sort of cancels out the other. But just a whiff of potential QE has sent some of these peripheral stock markets the Greek stock market was up 10% so far this year when I looked at it yesterday. I mean, it wasn't on our radar when we did our asset allocation at the end of the year for 2014. But the fact is they have to do something because there's structural frailties in the Eurozone. Those unemployment figures sort of say it all. So we'll have to keep an eye out to see if they do some further loose monetary policy in 2014. And the UK is certainly showing some tentative signs of recovery. Although it is a fairly nascent recovery, it must be said, and there's going to be more austerity in 2014. We'll just have to wait and see if there's some sort of triple dip on growth. The Bank of England's using forward guidance now. They've said there'll be no rate rise until unemployment falls to 7%, although it's currently at 7.4%, so they may have to revise that forecast at some point in the coming months. Help to Buy has been very supportive for the housing market. Obviously, as one would expect, there were 70,000 mortgage approvals in November 2013 compared with 53,000 at the same month last year, so there has been some evidence of recovery in the housing market. But the UK consumer households do remain heavily indebted, but there are signs that they're taking on more debt. We saw total net lending, it rose to 1.5 billion in November. Now, just a quick run through on the markets. In terms of growth forecasts, on the main regions, in terms of forecasts for growth and inflation, this was the IMF's forecast, but it's probably not, there is scope maybe to revise one or two of these up. It's really sort of steady growth forecasts for most regions next year, but still well below pre-crisis levels. Inflation expectations remain fairly well anchored in these developed regions. The Japanese are only forecasting 1.2% growth next year and 1.1% in 2015. We'll just have to wait and see how that pans out. Notice that the IMF are not forecasting a recession for any of these regions. The BRICS, they've been having quite a hard time of it lately because one of the legacies, if you like, of QE was when the dollar was weak, you had this sort of so-called carry trade where a lot of investors, a lot of institutional investors, they sold their dollars and they went chasing better returns in other markets around the world. And a lot of the money found their way into emerging markets where bond yields were much higher and dividends were attractive on stocks. And that sort of provided a boost to these economies. But with the spectre of the Federal Reserve easing back on QE last year, the dollar started to gain some strength and a lot of money started leaving these countries, prompting them to crank interest rates up at a time when growth was below trend anyway, because a lot of these countries rely on exports as a key driver of growth. Looking ahead, Brazil have got interest rates, their interest rates are about 10% at the moment. They've got inflation issues, but the growth forecasts for next year are very modest, but they are positive. The Russian, India seems to be on the road to recovery again after a sort of fairly difficult time. But certainly inflation in both Brazil and India remains at fairly high levels. As far as the stock market performance was concerned, 2013, a bit of a mixed year really for BRICS. These are all based on local currency returns. India performed particularly well last year. That's the BSE Sensex. Currently stands at an all-time high. The other three indices, they performed apart from Russia and China. Brazil had a bad year last year, so those three were down. But it also must be recognised that these indices all peaked some time ago. They have been lower, and they're sort of gradually back on the way up. Just on China, everyone sort of sees China as the future, the key driver of global economic growth going forward. What China's been doing with its banks in the last 5 years sort of puts what the central banks of the Western economies are doing into some sort of perspective. In response to the credit crisis in 2008 and fearing a slowdown in exports, the Chinese bank, the central bank, they put in about $600 billion worth of stimulus into the system. And since then, banks in China have gone on this massive sort of debt binge, buying assets all over the world, wherever they can get their hands on, to the extent that overall credit in China jumped from $9 trillion to $23 trillion since the Lehman crisis, which was 2008. the ratio of credit to GDP is now at 200% of GDP, and there are fears that the Chinese financial sector is overheating, and they may have their own sort of credit crisis. Now, you could say, well, China, they can't have a credit crisis. They are growing their economy at 7.5% a year. But it's the fact that the Chinese government sets this aggressive target that's actually it's actually forced a lot of local authorities and corporates to take risk to try and achieve those sort of growth targets. And most of it has been achieved through investment. Investment still makes up 68% of GDP. So we need to keep an eye on bank assets because they have ballooned over the last 5 years. As far as interest rates are concerned, these are the current levels in the US, UK and Europe, and everything that the central banks have said so far, the forward guidance suggests to us that short-term rates will stay at these historically low levels. We just need to keep an eye on inflation. If there is a recovery in consumer borrowing and credit, that could be potentially inflationary further down the line. Market rates, bond yields have crept up slightly, and we need to sort of just keep an eye on the ECB. As far as fixed interest investments are concerned, we still see bonds as fundamentally expensive. That column, that box on the right-hand side, the yields in the middle there, they were the returns on UK bonds when we last presented here in November 11. There's really been very little movement out to sort of 2 years. But beyond that, you can see that yields from 5 years out to 30 have crept up slightly higher, but not sort of significantly. There have been capital losses incurred for anyone who's been in those maturities, and that's again something that we need to keep an eye on, because it won't be central banks that control bond yields, it'll be the market that drives them. And if the market senses that there are inflationary pressures building, yields will start to ratchet up. The spreads on high yield debt, again, in this low interest rate environment, a lot of investors have been forced to, as I said, seek higher returns in other assets. Have encouraged investors to embrace risk and yield yet again. I just sourced this from the Financial Times website. From the Financial Times. It was in their paper at the beginning of the year when they were just talking about debt markets. And in this sort of quest to chase anything with yield, we're sort of seeing trends that we haven't really seen since before the credit crisis. Sales of leveraged loans and high yield bonds have jumped since 2009 and are above pre-crisis levels. Cov-light loans or covenant-light loans, these are loans that come with fewer protection for lenders. That's the bottom left box. They have just surged to a record in 2013. And issuers of junk-rated CCC bonds, these are well sub-investment grade issues, have surged, that's the top right box, as investors have pursued yields. And US collateralized loan obligations, which we probably thought we would never see again after the credit crisis in 2008. These are loans that are bundled together and are sold on as securities, as they were 6 years ago with a AAA credit rating from Moody's and Standard & Poor's, but not so any longer. They are very sort of poor quality, bundled, securitized debt. Again, back to close to surpassing where they were in 2006-07. Now, in terms of where we are with equities, again, we would acknowledge that equities remain relatively attractive to bonds, but some caution is required. We don't think that forward-looking price-earnings ratios are particularly expensive, but they don't look excessively cheap either. We're sort of looking at about 12.4 times forward earnings on the FTSE 100 index. Dividend yields remain quite attractive, and they're stocks that we can buy, obviously, not just in the UK but elsewhere, but they'll give us dividend income return of anywhere between 3.5% and 5%. We like the Far East Asian and emerging markets, but in light of where we are as far as the macro picture is concerned, what I was describing earlier, the potential for the US dollar to be strong in 2014 and even become a safe haven again potentially, we could see more outflows out of these regions. A lot of the countries in the Asian region are suffering at the moment because their exports are being, if you like, spurred because of what's happening in Japan. Their weak yen is making Japanese exports more attractive. But as long-term drivers of global growth, these regions are fine, but it's not an area that we would probably be piling into at the moment. We think the markets in the developed countries, probably chiefly Europe, the UK and America, have got scope for further gains in 2014. But we haven't really had any sort of correction of any description we didn't really get one. We got one in the second quarter of last year, but it was very short-lived, and we haven't really had one since. And there has been evidence, certainly in the last few months, that equity markets are looking slightly overbought at these sort of levels. They just keep grinding high. You sort of go in every day thinking, well, something's going to happen sooner or later, and a week passes and they've just crept up another sort of 2 or 3%. So there is, I would say, and you could argue that a correction of some sort would be good because it could shake out some of this sort of bullish excess and would provide a more sort of stable platform for longer-term investors to buy back in. Our preference really is to focus on sort of UK-listed companies. We're quite conservative investors, so we like stocks with good dividends, good cash flow, low levels of debt, stocks with international revenues, not ones that are beholden to any particular economy. And we have to keep an eye on earnings as well, because I think that slide I put up earlier of the market showed that share buybacks have been quite supportive for bonds, for equity markets over the last 5 years. But earnings are supposedly the key driver of price going forward. And we need to keep an eye on earnings and earnings forecasts against the current sort of economic backdrop. And we also have international exposure as well, because although you could say the Eurozone's in a bit of a mess, some of the world's best companies are listed on stock exchange across Europe. Firms like BMW, Bayer, Total, Unilever, Sanofi, those sort of firms. Now, I do accept the argument that equities offer good relative value compared to government and corporate bonds, but this is a sort of ongoing debate I have with a lot of new clients that have seen their friends make a lot of money in the stock market and are just desperate to get in themselves now. Timing is important, and we have to respect the fact. I'm not saying by any stretch that history will repeat itself. There's a good chance that it won't. But the fact is that we're at a sort of juncture now where the stock market is testing. This is the Financial Times 100 index of leading companies. It's testing that all-time high that it hasn't actually taken out since 2000. It's only about a couple of 100 points away now from where it is at current levels. And the fact is that on both occasions we've been at these levels in the last sort of 10 years, they have preceded very nasty falls of about between 45 and 48% as various sort of events have taken place. The first drop there was the bursting of the dot-com bubble, and then the post 9/11 recession. Interest rates were cut very aggressively by Greenspan at the time. The most recent one was the credit crisis blowing up and the problems in the banking system, and there was just this massive sell-off in equities. So we do tread carefully at these sort of levels. It's no one really wants to sort of risk being the last person in. So I think our sort of strategy at the moment, really, where we have new client money, we tend to sort of drip feed it in over a few months, and that way at least you can hedge your bets. If you like the companies that you're investing in and the market keeps going up, you're participating, and if their share price falls sharply, as long as you still like the company, it's a good opportunity to buy some shares at a lower level. These are just sort of some indicators that might suggest, again, that sort of in the US market, this is the S&P 500, the squiggly chart on the top right, that's the American Association of Individual Investors Bullish Sentiment Survey, which touched a 3-year high at the end of December. The American Association of Individual Investors noted at the time that the last time investors were this bullish, the S&P was at 1,274 points. It's now at just over 1,800, probably about sort of 40% below current levels. But it doesn't mean anything. It just means that at this moment in time, investors are quite optimistic as to the outlook for shares. Margin debt levels, that's the chart at the bottom there, and their rate of change. They're sometimes used as an indicator of investor sentiment, because margin debt rises when investors feel good about the prospects in the stock market. In the past, margin levels have peaked at the same time market indices have reached relative peaks. And there has been an increase in margin debt over the last 12 months as we've seen more money find its way into the market. The chart on the right, the big chart on the right, that just plots the S&P 500 index against the VIX. The VIX is a forward-looking index that uses options, traded options, to gauge investor anticipation of future volatility. It's often called the fear index because when it's high, investor sentiment is leaning more towards volatility and correspondingly higher risk. But we can see at the moment that it's not particularly high. In fact, it's very low. It got down to about 7, I think, in 2006, and at the moment it's about 12. Commodities underperformed developed equity markets in 2013. The potential headwinds that we need to keep an eye out for here are China, really, a stronger US dollar and rising supply expectations. Crude oil has been relatively immune to losses seen in other commodities, but rising US crude supply and moderation of geopolitical risks are all sort of negatives. And there has been incredibly muted demand for gold. I do sort of struggle really to reconcile the fall in the price of gold with constant news that the Chinese are buying up as much gold as they can, particularly from Hong Kong at the moment. But we sort of looked at this chart in November. Last time we were here, it was very much close to the peak. Well, it was at the peak. It was September 2011 that it reached this peak. And it's given up over about 30% of value since. Very difficult to sort of see why, but it's just a huge out of favour investment at the moment. I think people are coming out of gold. They've probably made substantial profits, and maybe they're chasing returns in equity markets. And things like, this has been evident in exchange traded funds that track the physical performance of gold. We buy one that's run by ETF Securities, and they said in one of their recent newsletters that their gold assets under management dropped to 76 billion from 147 billion at the start of the year, taking their gold assets back to 2010 levels. A huge net seller of gold. I think gold will have its time again if we do see more sort of uncertainty on the economic front or bad policy decisions. I think it will come again, but perhaps it's not one to buy at this particular moment in time. And currency, it's really just a case to see who can devalue their currency the quickest. At the moment, Japan is probably out in front, but I think they will have their wings clipped by their Far East Asian rivals. I suspect that the US dollar will remain strong because just as dollars found their way into emerging markets when the US was embarking on its aggressive QE, I expect a lot of Japanese yen will find its way into the US market as a potential safe haven in this aggressive monetary environment that the Bank of Japan is pushing. The Eurozone the euro has been strong due to the restrictive nature of EU monetary policy. They haven't been able to be as aggressive as America or Britain or Japan, and that will remain the case until they do something more on the QE or unconventional measures front. The Swiss central bank, it must be costing them an absolute fortune to keep pegging the Swiss franc to the euro. But that was they did that a couple of years ago to help keep Swiss exports competitive, and they're still doing it. And sterling has actually been a beneficiary of government austerity. They are perceived to be tackling the deficit. So, in summary, the main themes to keep an eye out for this year are the spectre or otherwise of more tapering in the US, but that's totally data dependent, and do comfort yourself in the fact that while we fret about these things, they're still pumping net $75 billion a month into the banking system. The US government debt ceiling is up at 17 trillion. I suspect that'll be a bit of a non-issue because Congress have already agreed a budget for 2014, and I think they will just allow the debt ceiling to continue to gravitate up. All eyes on the ECB to see what they're doing. I think the activities that Japan are doing, as admirable as they are, will create more tensions in the Far East with their neighbours. We have to keep an eye on the Chinese financial sector. The usual geopolitical risks are really the ones that are always there: Middle East, Japan and China over the Senkaku Islands. We've got European elections coming up in May. There's a Scottish referendum in the autumn, of course, and we may see, noting the unemployment levels in Europe, we may see some social unrest there as well. And the one at the bottom, I wasn't doing it just to be, provocative, but you really should go and Google search Fukushima Unit 4 reactor and just see the difficulties that the Japanese are going to have removing about 1,500 spent fuel rods or contaminated fuel rods from this toxic pool in Unit 4, this nuclear reactor that's in a very incredibly fragile state. It's all got to be done underwater because the isotopes apparently react with the air and can ignite, and that would set off a huge potential sort of radioactive cloud. I don't know much about these things, but it's been described by one scientist as when they remove these bars from reactors, normally it's a bit like lifting a cigarette that's intact out of a cigarette packet, but this is like a crumpled cigarette packet, and it's going to take them about 2 years to do it, and this pool is in a building, the pool's in the building, but it's 100 foot above the ground, and there's a race against time there to try and sort of make that plant safe, and hope that there isn't another typhoon or earthquake in the meantime. It's very interesting, but very serious at the same time as well. Overall, we expect the pace of economic growth to remain below pre-crisis levels. There's still too much debt fundamentally. And as always, really, the choice of asset is very much driven by the individual's attitude to risk and the potential return available on those assets. Investment portfolios, as we always say, need to remain well balanced by asset class and geographic region.